Okay, good morning, afternoon, evening, trader friends. Today, Friar thought we'd do something a little different. A book review of sorts, but not for its own sake. The book, Charles Mackay's Extraordinary Popular Delusions and the Madness of Crowds, was published in 1841 and is the foundational text of behavioural finance. Every serious market thinker has read it, and right now, in May 2026, it reads less like history and more like a live news feed. The three books on the left panel of the slide are the intellectual framework for today. Mackay, 1841, The Empirical Foundation, the case studies that documented how financial manias actually unfold. Kindleberger, 1978, The Theoretical Framework, Manias, Panics and Crashes, which formalised Mackay into a 5-stage model. Shiller, 2000, The Quantitative Measure. Irrational Exuberance, which gave us the CAPE, C-A-P-E ratio, as a numerical early warning tool. Together, these three books give us Charlie Munger's latticework of theory on which to hang the facts of what is happening right now in the AI IPO market. So who was Charles Mackay? Mackay was 27 years old when he published Extraordinary Popular Delusions. That is worth pausing on. He was not a grey-haired economist looking back over decades of data. He was a young, working journalist with a reporter's instinct for pattern recognition, documenting collective human behaviour with the rigour of a social scientist. The right-hand panel on this slide captures why the book remains in print 185 years later. Now here's some key names. Bernard Baruch wrote the preface to the 1932 reprint. Baruch was one of the great speculators of the early 20th century, and he lost a fortune in the 1929 crash before he came across Mackay's book. He wrote, "I have always thought that if, in the lamentable era of the new economics, the confreres who peddled their notions and the dupes who accepted them had known a little more about history, they might have escaped the greater part of the woes which were visited upon them." Jesse Livermore, whom Paul Tudor Jones cites as one of his formative influences, read Mackay and applied it to his short positions in 1907 and 1929. Charlie Munger lists it as essential reading. Warren Buffett keeps it on his shelf. The lesson, the book's value, is not in its age, but in its accuracy. Human crowd psychology has not changed between 1636 and 2026. Mackay's Three Manias. Mackay documents over 20 episodes of collective delusion, from rich trials to the Crusades to our... But the three financial manias are the centerpiece, and they are worth understanding in detail because each illuminates a different mechanism. First, tulip mania in the Netherlands in the 1630s. The Semper Augustus tulip bulb, a single bulb, traded for more than a canal house in Amsterdam. This is not a myth or exaggeration. It is documented in Dutch notarial records. The mania operated through futures contracts on bulbs not yet grown. This is derivatives trading in 1636. The key insight: the underlying asset was genuinely beautiful, genuinely real. Tulips are not worthless. The valuation was the problem, not the asset. This is the most common misunderstanding of Mackay. The crowd was not stupid. The momentum logic worked for 3 years. Anyone who sold in year 1 looked foolish through year 2. Collapse. When buyers simply stopped turning up at market, contracts were dishonoured nationwide within weeks. There was no orderly exit. Column 2, the Mississippi Scheme, France, 1719 through 20. John Law, a Scottish financier in the service of the French Crown, created the Mississippi Company with a monopoly on trade with Louisiana Territory. The territory was real, the revenues were not. The French Crown was the sovereign anchor investor. Regent Philippe d'Orléans backed the scheme directly. This is the template for how sovereign participation suppresses rational skepticism. Share prices rose 20 times in 18 months. Paper money was printed to fund participation. When gold redemption ran out, the entire edifice collapsed. The connection to today's GCC thesis: France ran out of gold just as GCC states are now facing fiscal constraints from Hormuz disruption. The sovereign anchor is under pressure. Column 3, the South Sea Bubble, Britain, 1720s. King George I was a company director. The ultimate anchor, half the British cabinet held shares. Isaac Newton, the greatest scientific mind of his age, lost £20,000, about $4 million in today. His observation, "I can calculate the motions of heavenly bodies, but not the madness of people." This is the single most important sentence in the book for our purpose. Intelligence is not protection against crowd philosophy. Psychology. Collapse speed from £1,000 to £100 in 6 weeks, 90% loss in 42 days. There was no bell rung at the top. Mackay's core thesis. Men, it has been well said, think in herds. It will be seen that they go mad in herds, why they only recover their senses slowly and one by one. Charles Mackay, 1841. This is not a metaphor, it is a precise empirical observation about the asymmetry between collective mania and individual recover. The crowd enters together and exits alone, and the exit is always too late for many. The 4 mechanisms on this slide is my distillation of Mackay's case studies into reusable analytical tools. Social proof, authority figures participating signal safety, but their participation means maximum optimism is already priced in. The signal is inverted. The king being in the South Sea Company was not a reason to buy, it was a reason to be deeply suspicious. Momentum logic. The mania participant who sells early is wrong for a long time and visibly so. The crowd that holds it repeatedly vindicated, until a single moment of non-vindication, which is catastrophic. This is why skeptics are punished and why the mania runs longer than rational observers expect. Narrative over numbers. No mania asset is valued at current earnings. It is always a story about the future. Louisiana Territory revenues, South American trade monopolies, unlimited AI markets. The narrative is unfalsifiable during the ascent because the revenues are always coming. They're coming. They'll happen. Yeah, believe me. Believe Elon. Asymmetric recovery. This is perhaps the most practically important mechanism. The ascent takes years and is gradual. The collapse takes weeks and is sudden. There was no orderly exit for the last buyers in. The intellectual lineage. Mackay did not emerge from nowhere, and his insights did not stop with him. This slide maps out the intellectual lineage that runs from 1841 to the present day. Mackay provides the empirical foundation, the documented case studies that established the pattern. He had no theoretical framework. He was a journalist, not an economist, but the pattern he observed was precise. Keynes added the theoretical language, animal spirits in the general theory, 1936. His beauty contest metaphor, that investors do not pick the most beautiful face, but they think the face that others will pick, is a formalisation of Mackay's social proof mechanism. Kindleberger built the framework, Manias, Panics and Crashes, 1978, drawing on Hyman Minsky's financial instability hypothesis. Kindleberger gave us the 5-stage model: displacement, credit, expansion, euphoria, distress, revulsion. We talked about this last video. This is the model we applied in the GCC capital withdrawal report to map where we are today. See earlier video. Shiller provided the quantification, the CAPE ratio, cyclically adjusted price to earnings ratio, which operationalizes Mackay's irrational exuberance, the phrase that Greenspan borrowed for his famous 1996 speech. Shiller published his book almost exactly at the Nasdaq peak in March 2000. The CAPE was at 44 times. It is currently at 35 times. Okay. Mackay applied then and now. So then the South Sea Company, 1720. Now the AI IPOs, SpaceX, OpenAI, Anthropic this year. So then monopoly promise, exclusive South American trade. Now monopoly promise, AI dominance, unlimited market. South Sea Company, revenue reality negligible. Trade barely existed. Now, with the AI IPOs, revenue reality, AI lost about $5 billion in 2024. AI, 10% of CapEx. Back, South Sea Company, Sovereign Anchor, King George I, Company Director. Now, Sovereign Anchor, Saudi Public Investment Fund. About $5 billion in SpaceX, plus Abu Dhabi's MGX fund. South Sea Company, Ascent, £128 to £1,000 in 8 months. A 681% increase. Now, Ascent, Anthropic valuation, $3 billion. 3 years ago, now it's $900 billion, and that's a 29,900% increase in 3 years. South Sea Company, crowd logic, if the king is in, it must be safe. Now with the AI, crowd logic, if the sovereign wealth funds are in, it must be safe. South Sea Company, trigger, King's gold reserves rang out. Now, trigger, the GCC sovereign wealth funds fiscal squeeze from Hormuz disruption. The parallel that matters most for trading is the sovereign anchor mechanism. King George's participation in the South Sea Company was not due diligence, it was the highest possible status symbol. Saudi's PIF, Public Investment Fund's $5 billion SpaceX anchor is functionally identical. It tells the crowd it must be legit. Mackay's observation, updated, the presence of a sovereign anchor investor should increase scrutiny, not reduce it. It means maximum optimism is potentially already priced in. The Mississippi Scheme, the Sovereign Dependency Template. The Mississippi Scheme is the sharpest historical parallel to our GCC capital withdrawal thesis. The substitution table on this slide makes the argument in the clearest possible way. French Crown, GCC sovereign wealth funds. The French Crown was not just a passive investor, it was the credibility engine. Without the Crown's backing, the Mississippi Company had no claim to Louisiana monopoly revenues. Without GCC sovereign wealth backing, SpaceX's $1.75 trillion valuation has no anchor. Next, Louisiana territory revenues, AI monetization at scale. Louisiana was real. The fur trade and agricultural potential were real, but the revenues that would justify the share price never materialized at the speed or scale that the narrative required. AI is genuinely transformative, but the revenues that justify a $900 billion valuation for a loss-making company like OpenAI not yet arrived. John Law's paper money, pre-IPO round valuations. Law printed paper money to fund Mississippi Company share purchases. The paper was backed by the promise of future Louisiana revenues. Therefore, VC round valuations are paper. They are marks on a spreadsheet, not verified by public market price discovery. The IPO is when paper meets reality. Next, France ran out of gold. GCC sovereign wealth funds face a serious fiscal squeeze. This is the mechanism. The Mississippi Scheme did not collapse because Louisiana was worthless. It collapsed because the financing structure that sustained the valuation was contingent on France maintaining gold reserves, and that condition changed. Saudi's public investment fund's US equity portfolio has fallen from $15 billion in 2021 to $12 billion first quarter 2026, 3 consecutive quarters. The financing structure appears to be changing. Sovereign-backed manias do not end because the underlying technology is worthless. They end because the financing structure that sustains the valuation is contingent on conditions that change. Quote via a Friar research. Shiller's CAPE ratio, the quantitative signal. Mackay and Kindleberger give us the qualitative framework. Shiller gives us the number that tells us where we are. The CAPE ratio, cyclically adjusted price to earnings ratio, takes the current S&P 500 price and divides it by the average of the last 10 years' real earnings. This smooths out business cycle distortions and gives a reliable long-run valuation measure. Okay, the 1929 pre-crash, CAPE would have been at 32.6 times. The crash took the market down 98%. 1966 peak, 24.1 times. The subsequent 16-year bear market cost investors 75% in real terms. 1999 NASDAQ peak, 44.2, the highest ever recorded. The subsequent crash was 80% down on the NASDAQ. 2009 post-GFC, 13.3, the buying opportunity of a generation. 2026 current estimate, approximately 35.5. It's getting high. At 35.5 times, we are above the 2029 level. We are below the 1999 peak. Shiller's research shows that at current CAPE levels, the expected 10-year real return on US equities is approximately 2 or 3% annualized, barely above inflation. This doesn't tell us when the correction comes. It tells us the probability of a significant drawdown over the next decade is elevated, and that the expected return from here does not justify the risk. Thus directly consistent with the QQQ bear leap thesis. This slide is the synthesis. I've applied Mackay's criteria derived from his 3 case studies as a checklist against current AI IPO market. The score is 8 out of 8. Every criterion is ticked. Transformative technology with unclear future potential. AI is genuinely transformative. No serious person disputes this. But transformative is not the same as valued correctly. The telephone was transformative. AT&T investors in 1900 still lost money if they overpaid. Valuations disconnected from current earnings. Anthropic at $900 billion valuation has never generated a profit. OpenAI lost approximately $5 billion in 2024. These are not criticisms of the technology, they are observations about the price. Sovereign anchor investors providing social proof. The Saudi PIF, Abu Dhabi MGX, ADA and G42, the Gulf sovereign ecosystem is credibility engine for the AI IPO pipeline. This is functionally identical to King George I in the South Sea Company. Crowd logic. If smart money is in, it must be safe. This is the South Sea mechanism, operating in real time. The reasoning is SoftBank, Saudi PIF, Abu Dhabi are in, therefore it must be safe. Mackay's counter, their participation means maximum optimism may already be priced in. Momentum punishing skeptics. Every private round has exceeded the previous. Anyone who called Anthropic overvalued at $15 billion watched it reach $900 billion. The skeptics have been burned repeatedly. This makes the crowd more committed, not less. Sovereign anchor under fiscal stress. Saudi's public investment funds' US equity portfolio have declined 3 consecutive quarters. The Q1 2026 13F submission confirmed it. This is the condition change that the Mississippi scheme template predicts. Public market price discovery approaching. SpaceX, June 2026. OpenAI, AI, September 26. Anthropic, late 2026. The IPO window is when paper valuations meet reality. This is the gold conversion run equivalent. Shiller's CAPE ratio confirming overvaluation, around 35.5%. Only 1929 and 1999 were higher. Both were followed by severe multi-year drawdowns. Isaac Newton's quote, "He is arguably the most intelligent person alive in the 1720, and he still lost the equivalent of $4 million in the South Sea bubble. Intelligence is not protection against crowd mania." Finally, there's doctrine implications, Friar's watch list for you to look through, and very importantly, Friar's recommended reading list. definitely start with Mackay and Livermore. Okay, and always remember, the big money is not in the buying and the selling, but in the waiting. Charlie Munger. Have a good day. Good trading.